Hello, everybody. Thank you for joining us today. This is our NAILBA VUL panel, and we're very excited to be here. We've got a great group of people here to put input into the VUL marketplace and hopefully give you some insights into what we're seeing out there as it pertains to VUL and all the good things surrounding that. So my name is Charles Arnold. I'm the CMO over at the Leaders Group. We're a broker dealer that works with a lot of BGAs and insurance distribution folks. And we have a wonderful group of people, like I mentioned. We have Doug Winkler. He's the Vice President, Independent Distribution for Prudential Financial. Welcome, Doug. We have Stevan Cohen, Vice President, National Sales Manager for Lincoln Financial. Those would be our two insurance carriers on the panel today. For our two brokerage general agencies, or BGAs, we have Kurt Thomas. He's the external wholesaler for J.L. Thomas and Company. And Chuck Anderson. He's a national sales director for Diversified Brokerage Services, or DBS. So thank you all for being here for the panel. And I'll go ahead and jump into things. And it's pretty informal. So we'll just talk about the subjects as they come up. And hopefully we'll have a great panel. So question number one. What are your general feelings about VUL? From the carrier or BGA perspective, I know this is a broad question, but it's a good one for us to start with as we discuss. So starting with the carriers and then the BGAs, just give us your honest opinion of what you feel about the VUL marketplace right now today. Doug, we can start with you on this one.
Sure, Charles, and thank you for inviting me to be on this panel. I really appreciate it. I would say the word I would use would be optimism. From Prudential's perspective, 5 years ago, 2/3 of our sales really were comprised of GUL and term. And now today, it's 2/3 VUL in term. So if we look at some of the leading indicators with the industry, right? So LIMRA just came out with the recent market report and indicated that 11% of industry sales are now VUL. 5 years ago, that number was 6%. Now, back in 1999, believe it or not, it was 33% of industry sales. So I think we're clearly on a trajectory that's going to lead us at some point, I think, closer to 20% of industry sales. And what makes me say that or believe that is two things. First, I think the market conditions are absolutely right. The economic indicators would tell us that VUL is a really good spot to be. Secondly, recently, IUL has been sort of the dominant new product, right? But with low interest rates, meaning lower option budgets, we think that the opportunity to transition to VUL is very strong. In fact, we know today most of it's protection-based VUL, but we're starting to see more customers comfortable with less guarantees for the trade-off being better performance in their VUL contracts. So accumulation type products. I know we're going to talk later about some of the positive momentum that's going on in the industry, but I'm very optimistic, Charles, about VUL today for sure.
Fantastic. So are we. And Stevan?
Well, first, Charles, I want to thank you for the opportunity to be part of this panel. And also, I want to express my gratitude to the members of NAILBA for what they do for our industry. And we're just proud to be associated with that organization. I'm going to echo a lot what Doug said. I think, Lincoln is extremely bullish on the VUL space. We've been a market leader in this product line for over a decade. We have a very diverse portfolio, both from a guaranteed as well as a current assumption perspective. And when you look at the market demographics, the realities of manufacturing products in this type of environment, I think you're going to see manufacturers of life insurance products continue to look at variable as a viable solution. There is a huge retail value out there, and our distribution partners are absolutely embracing VUL. I think the number one message I'd like to send out to our BGA partners is, if you're not currently wholesaling variable life insurance products, get on board, because I truly believe that's where the future is, and that's where the growth is for our third-party distributors. So, Charles, again, we're bullish from a Lincoln perspective, and we look forward to the future.
Thank you, Stevan. And, Doug mentioned he's optimistic. Stevan, you said you were bullish. I also want to hear any of the bad you have out there as far as your impressions as we continue to discuss today it's important to have that perspective too. But also to echo Stevan, as far as BGAs entering the space, we'll talk about that a little bit more about what that entails. But we as a broker dealer, as well as the other broker dealers in the industry, I know are in a position to help you along with the carriers in understanding the marketplace, but also putting yourself or your salespeople, depending on how you want to set it up, in a position and get registered to offer the product to your distribution. So I don't want to take too much. Kurt, we'll move to you at JL Thomas and Company.
You know, we really think that the future is variable life, especially in the protection space. We've seen a tremendous growth in the sale of the product, and you know, like Stevan said, we're bullish as well. A lot of the pricing is very competitive. You know, Doug said that a couple of years ago, most of Prudential sales were GUL, well, now it's VUL because of pricing. You know, I think the economic environment with low interest rates have hurt whole life sales, and I think you see a little transition over to the variable life side.
Very good. Chuck, go ahead and weigh in.
Yeah, well, I'll just echo the positive comments here. I mean, I guess on a concern level, I would want our consumers to really be very cognizant of the market's ups and downs. So it's really good to have a balanced approach to the different sub-accounts that they choose. But this is a great time to get into the market. And really, it's made our industry better, I think, to have a resurgence of the variable product. As Doug pointed out, it's spread out more across a bigger product array, which I think helps consumers. It helps brokers serve the client's needs. So I think we should ride the wave, and I think it's a positive one. So
fantastic, Chuck. Yeah, we talk a lot amongst ourselves, but in the industry, you know, we need to discuss some of those sub-account options, especially as market performance is the way it is, making sure customers understand that equity exposure, their portfolio as a whole, and maybe some of the different options that have kind of come to light in the variable life marketplace for sub-account options that didn't exist 5, 10, or 15 years ago, that make it a more versatile and perhaps even more protection-oriented product than it ever really has been. So we'll get into some of that as we go along. The second question I had for the group is more along the lines of objections. Now, as carriers speak to BGAs, you run across BGAs that do not like variable life, do not involve themselves in that business at all. And then from the BGA perspective, you run across a whole variety of different advisors and downline agents that for one reason or another do not really embrace the variable life story. They maybe had a bad experience. They just don't like it. They like traditional guarantees as opposed to any kind of exposure for equities, things along those lines. So my question here is really, what is that main objection or a series of objections that you run across all the time? What are your kind of ways to perhaps overcome that? And I'll start with the carriers, once again, and I'll start with Stevan this time with Lincoln.
Okay, thanks, Charles. So I'm going to attack it from two perspectives. One is the agent's concern, and then number two would be the BGA concern. When we talk to agents out in the field, I think there's a misconception about the cost associated with variable life, and I think we've all experienced that. Number two is the commissions that are paid on these products. I think we all realists. We know that agents want to do the right thing for their clients, but they also are looking at what they're being compensated on. And there is a concern around going through a broker dealer and the reality of the compensation that's out in the street. And then lastly, there are, Reg BI concerns. I think agents like to go past a path of least resistance, and there are other options out there that they may feel bring value. So I think from the agent's perspective, it's those three components. On the BGA side, quite frankly, it's the complexity of the distribution model and the uncertainty of who they can work with and who they can't work with. And, from a Lincoln perspective, and I know Doug as well from Prudential, our job is to make it easy for BGAs to understand how to navigate those very complicated waters. And it's around education, Charles. It's around making sure that they know what firms they can work with and partner with, which firms they can't partner with, and making that experience as seamless as possible. And I think that's the obligation, not only of the carriers, but the broker dealers themselves. I know your firm does a great job in simplifying the process. And of course, our BGA partners as well want to make sure that they are working with their agents and leading them in the right direction.
Thank you, Steven. So Steven had mentioned, cost, compensation commission, and some regulation hurdles, if you will, barriers to entry on the agent side, and then really trying to work with the BGAs to understand on the distribution side how they can work. And Doug, what's your take on it?
Yeah, when Steven opened with his comments, with his passionate plea for general agencies, if they haven't gotten their variable license to do so, I think it really starts there, right? I was having, maybe it was 16, 17 months ago at a meeting talking to some producers that had let their licenses go, had let their variable licenses go, right? So that's both the case with some producers that sell life insurance as well as with agencies that perhaps had it, let it go, or just never had it. So now you start there and you think, well, all right, we have to convince them to come back into the marketplace. But from the general agent's perspective, where is the growth? Where are new financial advisors that are where are they going to come from? Likely in institutions, likely in broker dealers, right? So what's their big concern when it pertains to selling life insurance? Well, it could be embarrassment. It could be the product's too complicated. It could be now I've got to manage sub-accounts, and what if something goes wrong and I put my client's relationship at risk because of underperformance? So I think going back to some of Steven's comments around education, we have new technologies that manage policies like that we never had before, just 3 or 4 years ago. Now we have the ability to get cases through underwriting in hours instead of months. So some of these new things that we have should be putting at ease financial advisors' willingness to talk to their customers. And then Kurt also mentioned before, protection, having guarantees in the product, I think will all help overcome some of those objections that are out there. That's really what we're seeing today, Charles, in terms of some of the objections to getting into the market today.
I think those are great points, Doug. One thing when you mention new technology in the platform that both advisors and customers can interact with for their policy, it was very difficult to kind of do that. And now with the new technology and the platforms, it's almost like managing your 401k. You go in and you see the pie, you see the allocations, you can make the changes, you see the performance. Didn't always used to be that way. So I think we're getting a lot better on that side of things. And since Doug, you mentioned Kurt, we can go to you from the BGA perspective.
I think the biggest challenge that we have is knowing the selling agreements that are out there. And I think a lot of reps don't know who they can write variable life through it, for a brokerage agency. So I think the transparency needs to get a little bit more transparent. We've had some cases where the rep thinks he can write it through us, and we do all the prep work, the quotes, the underwriting. And then we found out, you can't write it through JL Thomas because there's, a special deal that the BD has. So, I think if there's more transparency, it'll help drive more sales. And education, I think a lot of agents think negatively about variable life because of what it did in the 90s. It's not your grandfather's VUL anymore. It is truly a no lapse guarantee. Sale is how we push it. So those would be my two concerns moving forward for variable life.
Thank you, Kurt. Chuck?
Yeah, I'll just bring this one to a close. I mean, I definitely was thinking a lot about the things that Doug and Steven and Kurt have already mentioned, and I'll highlight one more. And I picked this up from the case design team that works at DBS. So we have case design analysts on the phone all day long with advisors. So I was actually talking to Tyler Jarris this morning, and I just said, well, what's the biggest objection you hear? And he was very quick to tell me that, and Kurt just mentioned this, it was the fact that they were burned once before in the variable market. And, really date some of these people because they'll talk about 1999, but they'll also talk about the crisis in 2008. And for some people that stung so hard that it stays with them. And I'm really glad that through a lot of the efforts that the carriers have picked up on, and NAILBA that we've really created a resurgence, and hopefully those painful memories from a couple times that they got burned in the past will go away, and we'll kind of think about this more optimistically in the future.
Thank you, Chuck. You know, Kurt had mentioned some of the challenges in the distribution space as it pertains to working with broker dealers, maybe working with RIAs. There are different relationships that need to be kind of put in place to get that permission to work with those agents. And some of the broker dealers, for better or worse, have gone with the mantra that less is more. And they've started to reduce some of the access for some BGAs with their agents and producers. And it's a bit of a shame because we know everybody brings great service to the table. And we know that more involvement for the life insurance discussion would be a positive thing for the consumer and the agents in general. But that continues to be a challenge, and we'll touch base on that a little bit. But Chuck, one thing you had mentioned, you know, going back in the pain that people have experienced with variable life in the past, you know, pain is a big reminder for anybody. And to go through that type of pain again, to sell variable life, put their trust back into it after it hurt them and their customers is difficult to do. And I hope we can get through that process. And one of the major kind of developments that we've seen is, and it comes back a little bit to some regulation that has come through with AG 49 and 49A, particularly impacting the IUL market in particular, because it was probably regulation that was a little overdue. But what happened was it shifted some of those IUL sub-accounts into the VUL chassis. And it provides a downside protection option, which really did not exist to a large degree for variable life in the past, while also giving upside potential that's better than those low fixed rates that the market's dealing with also right now. So I guess this question is what do we think about those IUL sub-accounts within the VUL lineup? You know, I don't think it's meant to replace the IUL market. That has its own place and its own power. But I think it adds another dynamic and flexibility to a very nice VUL lineup as far as downside protection and client options. So I can start from the BGA perspective, and let's start with Chuck on this one, since you kind of just gave me the insight for lining up that question.
Yeah, I think we should embrace that. I think it's already helping the VUL marketplace to create some parity between the IUL contract and a VUL contract. We want clients to have the best options, right? And so when we used to think about a variable product, we thought about those periods of time when the markets went down and it created that lasting impact. And if you really stop and think about it, if the product designs that carriers like Prudential and Lincoln are working on can actually increase the number of options and create more of a safety net for the consumer, I think that just makes the product better. And for the advisors, it's amazing how many sales ideas and concepts can be collapsed into, I'm not saying variable is the only product, but with these new IUL type sub-accounts, it really opens the doors to use them more broadly across their practice. So I'm optimistic about that. I think it definitely it behooves the advisor to really understand each and every option they're presenting. And I think we as an industry need to embrace some of the regulations like Reg BI, as they're intended to make it safer and better for consumers. So let's do our part by following those and doing what's right for the end customer.
Certainly. And one thing from our broker-dealer perspective on this a little bit is making sure that the agent and the customer understands the lock-in periods for these IUL sub-account options, because sometimes they think it's just like a fixed money market or something along those lines, where it really is locked in for a period of time. So we've run into some issues where customers put it in there and want to take it out right away. So make sure they understand that lock-in period for those IUL options. Kurt, do you have any comment on this?
I mean, to echo on Chuck, I think it's helping increase sales. You know, you're getting the best of both worlds. Variable sub-accounts have no caps, no floors. and IULs have downside protection, but they have a cap, right? So, I think if you're planning for supplemental retirement income planning, having an indexed account option is very important, especially during distribution time near retirement. Also, too, I think, there's some advisors that have concerns in the index space in terms of carrier control, in terms of changing cap rates and things like that. So I think from a flexibility standpoint, adding index account options on the variable chassis is fantastic.
Yeah, that's a really good point with the flexibility piece there. Stevan, what's your take?
No, I'm on the same page with Kurt and Chuck. It's about having integrity at the point of design, making sure you're using these products the right way. It's not a replacement for IUL. It gives the client flexibility, especially in the distribution phase, as Kurt said. Lincoln, we've been a benefactor of that. Our Asset Edge product has had index options now for over a year, and it's our number one growth product year over year is Asset Edge. So we're definitely being a benefactor of that strategy, and we look forward to continuing that trend as we roll out our new portfolios in the years to come. So I think we're all on the same page here. Optionality and choice is good in the hands of credible agents, designers, and professionals, and I think we all would agree with that.
Doug, you get the opportunity to go last on this one, and any input?
I'm used to that, Charles. My last name is Winkler, after all. W. I've had to deal with that a long time. No, I'll just take a little bit of a different tact on this question, because as a carrier, it wasn't that long ago that we went through PBR, right? We had to get all of our products into that regulation. So there was fire sales at the end of the year, and then this year 7702 came upon us, right? So now all of a sudden we've got to change our corridor factors and get our products up to speed with 7702. So what has that limited us the ability to do? It's limited our ability to innovate, right? So what you see adding sub accounts with indexed options, right? Instead of maybe some innovation that would maybe perhaps offer some newer products to the consumer that don't have everything inside them, but have a certain lane that they may be in. I'll give you one example in the annuity business. The annuity business, obviously, the cost of guarantees, and you've seen this happen in the variable annuity marketplace. Many carriers have actually gotten out of that because of the cost of those guarantees, and they've moved to these buffered strategies, right? And buffered strategies are very different than anything that we've seen today. It could be a very good option for an index product sale. So what I suspect will happen is everything that we're talking about now is carriers have more time to innovate. We'll start to see new products emerge, right? That don't necessarily have 72 sub accounts, because who can choose between 72 sub accounts, right? So products that fit different niches, that different needs and wants that clients have, I think will start to emerge. So you'll have the ability to get the both of best worlds, but look at a product that is really designed to be in this lane of, has a floor, okay, does have some sub accounts, but doesn't have 62 options, gives the client the ability to have guarantees based on what they're comfortable with, being able to dial those guarantees to what they feel they want to pay for. So I think we're all talking about the same thing. I think innovation fuels some of my optimism. I also think with 7702 and the likely tax code change with capital gains and ordinary income tax, the best is yet to come without question for these types of products.
Right. I think you're spot on with some of the innovation on the annuity side with those RILAs and those specific options for period of time and caps and floors and the different things they provide. So I think you're right in the sense we'll probably see some of that drift over to the life side and create some great opportunities. You did mention, 7702 and some of the recent changes with that. It kind of segues nice into some of the external factors and regulation kind of discussion. And I had one primary question that pertains to this kind of category. And there's always factors out there that can impact the VUL market. There's several here, and I think we can go around and pick out the ones that we think will have a unique or focused impact on variable life specifically. So here are some of the factors that I've seen out there, and you can always add a factor if you think I'm missing something as well. But persistently low interest rate environment, right? That's particularly hard on a lot of the carrier partners. ongoing COVID pandemic. You know, I think that's just brought a lot of awareness in life insurance in general. It hasn't really been a negative for life insurance, I don't think. Maybe some of the challenges in the underwriting and carrier perspective, but I think generally people start thinking, well, if I could get sick, I could die, and what would be there for protection? So I think that generally is out there. Regulatory changes, you got Reg BI, best interest. You also have the new DOL rule that's kind of floating out there right now that could have an impact primarily on the annuity side, I think particularly, but also will impact other types of sales. Actuarial guidelines, reserve requirement changes, the old AG 49, the 38, all the different things that are out there that could potentially change. Accounting changes, this came up in the conference I was at today, and something from a carrier perspective may impact a little bit was the GAAP accounting standards changing and the way in which you calculate your books on the carrier side might have impact on some of the guarantees and product out there. Increased taxation. I think if you're going to ask somebody, their tax is going to stay the same, go up, or go down. I think most people say they're either going to stay the same or go up. That's pretty much a given, I think. But everybody has an opinion around that. And then the overall equity performance. You know, we have people, customers coming to our advisors saying, "I didn't make enough. You know, what was the issue? I should have made 20% instead of 15." So you have this kind of capitulation of the markets. It seems like a lot of interest and involvement since the COVID little crater. And we've had tremendous equity exposure, which is good and bad. But all these different factors, and I know that's a lot of them, but maybe you can pick out a couple. And I think I'll start with the BGA side. Maybe Kurt, I can start with you on that.
I think it's a tough answer. I mean, there's so many things. I think low interest rates have really helped change the scope of products in our industry, you know, particularly with whole life insurance. I think the dividends have gone down and those products are getting harder and harder to sell. And I think those advisors are looking for alternatives. And I think variable life is a good alternative to participating whole life.
Very good. Chuck, what's your take?
I'll pick up on where Kurt was going with interest rates. I'm not an actuary, so I'm not even close, but I do understand in my years of working, especially at the carriers, that the variable product is profitable for the carriers, that there's a number of reasons why this is a favorable product line for the carriers to give us some good pricing with. So, I mean, I feel good about the future there. The actuaries can check me on that. I also think it's kind of the perfect storm right now, and storm in a good way, that you mentioned taxation, Charles, and really taxes, they are going to go up. There's going to be a need to generate revenue from estate, from estate taxes and other things, given all the spending that's happening. So I feel like it's a good time to be in our industry, that our products are going to be very relevant for the foreseeable future. And then you mentioned COVID, which I think has woken up people's awareness about their own mortality. So that's creating a good demand for our products. So along with that comes regulation and things that maybe could be looked at as a barrier. But if we embrace the things that are coming our way, regulation changes that are occurring that, like Doug was saying, was really crowding the plate of the product development side. That's okay. We'll get through those things and come out with more innovation in the future. So I just think it's a good time to be in our business.
I agree with you. It gives us a chance to adapt and change and overcome whatever's thrown our way. Doug, from a carrier perspective, I know that's a lot still that was thrown at you and discussed already, but what do you think?
Yeah, I think these guys nailed it. The one thing I would add is that capital is king, right? Because of the low interest rate environment. So the capital that we in our life insurance division are asked to use to build products. The one other fear that's out there that we have to be cognizant of is the fear of an equity shock, right? And so we're reserving. So if you go back to March of last year, I think, Charles, you would know this, right? The Dow was, I think, at 18 18,500, right off of a 27 high earlier in the year. Now it's almost 35,000 or over 35,000. So at the time we went from 27 to 18, right? So what happens in that scenario is we still have to make sure that we're providing the capital for the death benefits that we've guaranteed. So when there's a large equity shock like that, there is essentially a call on capital. We have to put more capital into our products to make sure that we're reserving for them profitably. So that's the one wild card in VUL, especially in protection VUL, is can you make sure that you're caring for that potential equity shock? So that's where you'll see some more innovation, whether it's flexible guarantees or making sure that there's an accumulation strategy within the VUL. But that's the one concern that certainly has us very aware, for sure.
And for anybody listening, for their benefit, Prudential and Lincoln are the leading carriers in this space. And especially as it pertains to that guaranteed VUL space with both the Protector product and the VUL1 product. But Stevan, what's your take on it?
No, I'll just put a bow on this discussion. Doug nailed it from a carrier perspective. The use of capital, the efficient use of capital, it's critical. So we're always looking to make sure that we're manufacturing products that bring real retail value so our distributors can be comfortable in showing it. And when you look at the reality of a low interest rate environment, a volatile stock market, the need to manage capital efficiently, variable life insurance is in the sweet spot for companies that manufacture solutions on the protection side. So that's why I'm bullish for this whole discussion around variable. I just wanted to take one second here. Doug talked about innovation. I know we're talking about core life insurance, but that Lincoln rolled out a variable linked benefit solution, MoneyGuard Market Advantage, and I think that shows our commitment to the space. So it's not just on the protection side, but you're going to see variable come into other solutions, whether it be long-term care, accumulation sales, pure death benefit, wealth transfer sales. So we're all very well positioned as an industry, and I'm really, really excited about the next 24 months as we see the impact on some of the Washington decisions or long taxes, wealth transfer, individual tax rates, business tax rates. So the best is yet to come. I think Doug said that, so I'm gonna steal that line. I like it.
I like that too, and that brings me to kind of a nice little avenue towards another discussion. Is the usage of LTC and chronic illness riders, and the positioning together with permanent policies such as variable life. And I know that Prudential has their benefit access bar rider, and Lincoln has their LTC rider. And so I guess this really is kind of positioning idea, that combo type sale. I live too long, I die too early, or I get sick along the way. That sick along the way is what you're trying to create a pool of cash they can draw on to help themselves and help their families. And so, Chuck, I don't know if you have any experience kind of positioning that combo type sale with customers. I know it has to make sense for the customer, but any insight onto that type of sale?
I actually think it's one of the breakthroughs that we've had in our industry in the last several years with the access riders being added to products. And it very simply comes down to need, that getting sick along the way, that is something that if you're over 65, I think the stats show that 7 or more out of 10 consumers are going to have a chronic illness need happen in their lifetime. I'm old enough now that I've got my wife's parents are in that situation. We just find it all over the place that there's this need for some type of chronic illness care. We're all caretakers for our older generation, and thank goodness there's a product solution that fits that need. So I think the demand is going to continue to be high. And I did check with our team. I think you and I were trading emails earlier, Charles, that over 60%, closer to 70% of all of our illustrations go out when it's a permanent product with a chronic illness type LTC rider attached. And that just speaks to the need being great. And to the greatest extent possible, we're going to educate advisors to make that part of the sale conversation. So plan on that continuing.
Absolutely. Thank you, Chuck. And Kurt, from JL Thomas's perspective, how are you guys positioning it?
I think a lot of cases that we generate come from policy reviews. And a lot of clients have older contracts that don't have guarantees. They're in their 60s. Their kids are grown, educated, and gone. Their house is paid off for. And they're sitting there near retirement thinking, why do I need life insurance? And I think the number one reason is end of life care planning. And you look at the industry, we have one carrier that offers traditional long-term care. So the demand is not with traditional long-term care, it's with life insurance with living benefits. So a lot of our cases, 1035 exchanges especially, with the long-term care or chronic illness rider, you know, those are great solutions for the customer.
Absolutely. From the carrier perspective, any insight? We can start with Stevan.
Yeah, we're seeing, traditionally the majority of our protection sales are being asked to be run with some type of a long-term care solution. I mentioned our link benefit flagship product MoneyGuard, which, is another end of that discussion. And we're also seeing an interesting phenomenon. We're also seeing on the accumulation side where typically adding the rider is a little bit of a drag on performance. We're seeing a lot of level death benefit options being put into the marketplace. And because of that, we're seeing the long-term care rider actually being added to that solution as well. So it's definitely a growing end of the business. I agree with Chuck. It's, it's the right thing to do. It's around long-term holistic planning, and we're benefiting from it, as I'm sure most carriers are. But we're seeing the same dynamic, Charles, as others.
And Doug, I know you've got a lot of success with that bar rider and so on with your product. Any insight?
I mean, I think momentum is clearly on our side as it pertains to living benefits. And I think it's great because it makes consumers, clients want to own the policy versus just thinking that they need to have it. My dad, unfortunately, passed away a few years ago from complications from Alzheimer's. I own a Prudential policy that has the benefit access rider on it. We're coming out, hopefully knock on wood, coming out of the pandemic now. And we've seen, what's happened with caregiving and nursing homes and, who wants that, right? So I think, we've seen the utilization of benefit access rider grow over the last several years, and I think it'll continue to grow. In fact, right now, over half of our eligible policies have the rider sold with it on it. So I think the best is yet to come when it comes to long-term care planning with life insurance riders.
Absolutely. Well, this is coming to a close as far as our panel discussion. So we're going to kind of enter the lightning round stage of a nice conclusion for each of you. And I know I just sprung this on you, so I'll start from our perspective. We're a broker dealer in this marketplace. We serve BGAs and their customers, and we work in the distribution of variable life. So if there's any questions that anyone has regarding that process to get set up to offer variable, the registration, the regulatory components, or just VUL in general, what we're seeing, please let us know. We're here for you, for this community and the full NAILBA community to help out with anybody involved in the sale of registered products. So we're very bullish on everything. I think all the wonderful components we've talked about should kind of pave the way in your VUL decision and discussion, and hopefully add some more clarity to it all. So I guess with this conclusion lightning round, we can start with Chuck. I'll put you on the spot.
Just kind of from a final message standpoint, I want to thank NAILBA for being so involved in this industry, in this way, in terms of getting into the depths of the VUL product line. And maybe another message would be to the carriers, and you mentioned both Prudential and Lincoln were leaders in this space. Anything that you're doing to simplify these products, be it underwriting or just further customizing the marketing materials to line up with a particular sales concept, those go a long way to building on the success that started. I think it was mentioned earlier how complex these products can be, but the carriers and the two that we have represented here do a great job of really isolating a particular concept and making it for the presentation to the consumer as simple as possible. And everything you're doing to digitize the process is money well spent. I've seen more adaptation to e-signature in the last couple of years than in the prior 10. So let's just keep it going. And just thank you for allowing me to be part of the panel today.
Well, thank you, Chuck, and for all that insight. We'll go kind of out of order from BGAs to carriers. We'll go with a Stevan at Lincoln.
All right, Charles, thank you. And let me first again thank the folks at NAILBA for everything they do for our industry and for allowing us to be on this panel today. The one word I'll leave is commitment. You know, Lincoln continues to be committed to the life insurance space. We're fully committed to third-party distribution with our BGA partners. It represents close to 70% of our total sales at Lincoln. And lastly, we're committed to the variable marketplace. As Chuck said, we want to bring value add, not only to the front end of the sale, but just as important to the back end. I think we would all agree as an industry to do a much better job there. So I'll be brief and just, Charles, thank you for everything you do. I will pass it on. I'm going to go now, and I'm going to let Kurt go. I'm taking control of this call now, Charles. I'm going to let Kurt go because Doug is going to be last. Because
of course, I have to be.
Kurt, jump right in.
Well, thanks, Stevan. Thanks, Charles, and thank you, NAILBA. Carriers, thank you as well. You know, these products that you guys have created are great. And I will say the best policy to own is the one that's enforced the day you die. Don't ever forget that. But VUL, I think it's a really going to be a great product moving forward in our industry.
Right on, Kurt. I love that message. That is spot on. And I would just say, you know, I was just finished a boot camp, virtual boot camp with my team, and we had folks on from service. And this year alone, we've paid out 220,000 claims and $4 billion of death benefits. So, you know, at the end of the day, that's what it's all about, right? It's about being there when you need to be there. And I want to thank NAILBA as well, and for your participation and watching this panel. And we learn, Stevan and I learn from folks like Kurt and folks like Chuck and Charles. So keep your ideas coming. This is a partnership, and we look forward to the future of VUL together. Thank you.
Okay. Well, thank you all very much, and thanks all for listening, and have a great day.